Every founder dreams of the moment a VC slides a term sheet across the table, but what if that moment is actually the beginning of the end? Before you sign anything, there's one question that separates the founders who scale from the ones who spiral. Do you actually need this money, or do you just want permission to grow faster? We have watched this story play out so many times, it is almost poetic. A scrappy team, a product with real traction, and then suddenly a war chest appears and everything changes overnight. The office gets nicer, the headcount doubles, and somewhere between the kombucha on tap and the all-hands Slack channels, the original engine that made the business work quietly stops running. Think of growth capital like rocket fuel. Poured into the right vessel, it breaks orbit. But poured into a leaky one, it just makes the explosion bigger and more expensive. The question is never really about the money itself. It is about whether your business model is structurally ready to convert capital into compounding returns, rather than just compounding expenses. Here's the thing nobody says out loud in pitch meetings. Most early-stage companies do not have a revenue problem. They have a clarity problem. Investors are not buying your current business. They are buying a specific version of your future. And the moment you take their money, you are legally and morally obligated to chase that future, whether it still makes sense or not. Cast your mind back to 2021, when every founder with a slide deck and a Notion template was raising at eye-watering multiples, and the headlines made it sound like money was just falling from the sky. Fast forward to 2023, and suddenly the same founders were doing layoffs, pivoting desperately, and giving TED Talks about resilience, which is a polite word for surviving your own decisions. Sequoia Capital did not mince words in their now famous RIP Good Times memo. The era of growth at all costs was over, and the founders who had confused capital with product market fit were about to learn a very expensive lesson. The irony is that many of those businesses had real potential. They just took on obligations that forced them to grow in directions their customers never actually asked for. So here is the historical pattern worth understanding. The most durable companies, your MailChimps, your Basecamps, your Craigslists, treated outside capital as a last resort, not a rite of passage. They scaled on customer revenue, maintained pricing power, and never handed a board seat to someone whose incentive structure was fundamentally misaligned with building something lasting. Now let us kill the biggest misconception right here. Taking growth capital does not mean you have made it, and refusing it does not mean you lack ambition. What it actually means is that the founder who raises strategically with a precise deployment plan and a clear inflection point in mind is playing a completely different game than the one who raises because their competitors did. The practical lesson from every cycle of boom and bust is embarrassingly simple. Before you take the meeting, model out what your business looks like in 3 scenarios. The capital works, the capital underperforms, and the capital gets called back under pressure. If scenario 3 destroys the company, your runway is not a runway, it is a countdown clock someone else is holding. Disciplined founders treat dilution like a tax. You pay it when the return on that tax is mathematically obvious, and you avoid it when the math is murky or the pressure is social. Position size matters here too. Taking $5 million when you needed $2 million is not ambition, it is drag. And every extra dollar of obligation reshapes the decisions you will make under stress 12 months from now. There is something almost philosophical about the moment a founder realizes that growth capital changes not just the business, but the psychology of running it. You stop asking, what do our customers need? And start asking, what does our deck need? And that subtle shift in orientation has ended more promising companies than bad products ever did. The founders who come out the other side of a capital raise with their culture and clarity intact are almost always the ones who were ruthlessly honest about their own readiness before they walked into the room. They knew their unit economics cold, they could articulate exactly what the money would unlock, and they had a plan for the day the market turned, because the market always turns. So what is the question every founder must ask before taking growth capital? It is simply this. If this money disappeared tomorrow, would we still know how to win? If the answer is yes, you are ready to scale. If the answer is hesitation, that hesitation is the most valuable data point in the room. Discipline, sizing, and consistency are the only moats that compound over time, not the size of your last round or the logo on your cap table. You can be comfortable with any outcome, when you have done the rational preparation, built the right foundation, and never let someone else's timeline replace your own judgment. Whether you are building a business, buying your first investment property, or trying to figure out how to fund your next big move, we can help you get started. Check out our links in the description below for real estate investing, home contracting work, and finding the right lenders.